Hello, happy 4th of July. I hope you guys are all enjoying the day, whether you're with friends, family, maybe working, maybe just hanging out. If you are in Arizona or Phoenix, hopefully you have a pool or some air conditioning because it's a hot one. But either way, happy 4th of July and thanks for joining me today for another Phoenix real estate market update. If you're new here, I'm Caitlin McKegg. I am a Phoenix real estate broker and I am always giving you guys an update on what's going on in our market on a weekly basis. A lot of this information is from the Cromford report, which I'm a subscriber to, and they are excellent at breaking down what's going on in the market. So if you are new, make sure you hit the subscribe button and the bell for notifications so you don't miss these updates every week, along with the other videos that I post throughout the week as well. So without further ado, let's jump right in and start talking about what we have going on July 4th, 2022. Lately, I've been talking about interest rates because that has really been a big factor in buyer demand and what's going on in our market. So I'm going to start there this week. Let's talk about mortgage rates. So we actually ended the week in a good way on Friday with mortgage rates coming down slightly. So the average 30-year mortgage rate fell to 5.7% this week, down from 5.81% a week ago, according to Freddie Mac. But a year ago at this time, our interest rate was about 2.98%. Ouch. So definitely a lot higher now, but at least we're seeing some movement downwards. And what's been happening is the rapid rise in mortgage rates finally paused, largely due to the countervailing forces of high inflation and the increasing possibility of an economic recession. Rates mirror the 10-year Treasury yields, which have fallen as investors seek safer, more stable assets in the face of higher inflation and slower economic growth. So we'll see what happens this week. Last week, things were good for mortgage rates, but we all know where things are heading with the Fed taking a very aggressive approach to combating inflation and will likely continue to raise the federal funds rate. So that remains to be seen later this month. We'll find out what they decide to do there. So moving on to home prices here, I wanted to share this article, which is from Redfin. They are making a prediction that the housing market is cooling. Obviously, home prices are flattening, but they foresee them flattening or rising modestly next spring, which I thought was an interesting take. Obviously, Redfin is looking at the entire country. They're not just looking at one market, but this is what their prediction is. They expect national home prices to be flat to 4% higher in the spring of 2023 compared with the year prior, due to slowing or negative economic growth and rising unemployment. So for everything that we've been hearing, that is a pretty positive outlook. I don't know whether or not they will be right, but every market performs differently, which is why I wanted to share this article talking about the cities where housing costs are likely to drop. And I like how they said we've squeezed a decade of home price appreciation into a year and a half. And that's really true. I mean, the gains that we have seen, especially in Phoenix over the last year and a half, are unheard of and incredible. And we all knew it wasn't sustainable, but it was just the question of how is this going to end and where do we end up after that? And so John Burns Real Estate Consulting is saying that Boise is the #1 market where they're going to start to see a decline in home prices as early as this year. And that is likely to be followed by declines in home pricing in Austin, Texas, Las Vegas, Nashville, Phoenix, Riverside, California, and Salt Lake City. Obviously, I'm sharing this because Phoenix is on this list. That's not surprising because we have been on these lists. We've been famous for all of the craziness that's been happening in our market. And so, of course, we're going to make the list as well of a place where we'll start to see a decline over other cities. Again, we'll have to see what happens with this. It's always hard to know with any accuracy, especially when they're looking at things from a national standpoint and not here specifically in Phoenix or operating here in Phoenix. But I do think that based on some of the information I'm going to share with you guys today, all of this is likely. We're definitely headed for balance for sure, possibly a buyer's market, and with all of that comes changes in home values. So if you watched my video last week, I posted a midweek video, I think it was on Thursday, about the contract ratio, which is another Cromford proprietary measure of what's going on in our market. And I had said, I'm pretty sure by next week we'll be under a certain mark, which puts us in balance according to the contract ratio. And that was correct. So 30 to 60 on this contract ratio chart is considered balance, and we just fell below 60. We're at 59.8, barely below 60, but nevertheless, the trend is there, so it makes sense to address this. Now, for those of you who did not see that video, the contract ratio is comparing the number of active listings on the market for sale as compared to the number of homes on the market that are already under contract. And so when you have more homes under contract than are active for sale, that ratio, the way that they calculate it, that number is higher, which means that there is more competition in the market. It's a hotter market, and it's a strong seller's market. And then when those two scenarios are flipped, we have a cooler market. And so when that ratio comes out to about 30 to 60, they're considering that a balanced market. And so we just jumped into that balanced market according to the contract ratio. Now, we were at 262.6 just 4 months ago, if you can believe that. I mean, 262.6 down to 59, that's wild, but you can see it all here in this graph as we've kind of gone all over the place over the last 2 to 3 years. But here's, where we were peaking and coming back down, and now where we stand today, right about there. Now 59.8 is the lowest reading that we've seen since March of 2019. And like I said, we're pretty much already in balance according to the contract ratio. Now, I have this little snippet down here from the Cromford report because I wanted to explain how they talk about the contract ratio. So if you're not new here, you know that I always talk about the Cromford Market Index. And that's a very reliable source, but this contract ratio is a bit simpler. And with that, they say it's an immediate measure. So the contract ratio has no averaging or smoothing effect. It's therefore very responsive to violent changes in the market. In contrast, the Cromford Market Index is based on averages over the prior 30 days and is smooth to avoid reacting to insignificant variations from day to day. It normally gives a more reliable picture of the market than the contract ratio. However, in times of dramatic change, which is where we are right now, it can move a little slower because of the averaging and smoothing. I would take signals from the contract ratio to be more up to date by an average of 2 weeks compared to the CMI. At the moment, the CMI is clearly telling us that the market is cooling rapidly, but it probably underestimates by a week or two just how far it has already cooled as of July 1st. The contract ratio is telling us that we're already in a balanced market. If it drops below 30, it will indicate a cold market with a significant surplus of sellers over buyers. We have not experienced a market like this since April of 2009. So that is why I'm sharing information with the contract ratio more often now, because we are in a time of very quick change. And so this is going to be more reactive to that and a bit more up to date, it sounds like, than the CMI is. So let's move on to talking about the CMI. Now that we know that news, here is your table of all of the major cities in the Phoenix area and what their respective CMIs are. For anyone that is new here, if any reading on here is over 110, that equals a seller's market. And then any reading under 90, that's going to be a buyer's market. And in between those two is balance. So anywhere between 90 to 110 is a balanced market. Now you can look at all of these readings here. We have quite a few that are approaching 110. Pretty much everything is under 200 except for these cities up there at the top, Paradise Valley, Fountain Hills, and Scottsdale. And Buckeye has been on our list to watch lately because Buckeye's been approaching 110 very quickly. They are, you know, 0.8 above balance at the moment. We can basically consider them balanced, I think, at this point. And Queen Creek and Maricopa are just behind them. According to the Cromford report, they're about a week behind Buckeye. The reason I have buyer's market written over here is because the Cromford report is saying we're pretty much headed for a buyer's market probably by the beginning of September. That's how quickly this has changed and fallen over time, and the trend continues, which will push us through balance and into a buyer's market. So that's the latest prediction from the Cromford report, which is very bold to say because for the longest time they've said the data does not support that, and it hasn't until we started seeing all these crazy changes happening so fast. So beginning of September, we may be in a buyer's market for all of these cities, not just Buckeye, not Queen Creek, Maricopa, all of these cities, majority of cities throughout central Arizona. They are saying that it will likely be in a buyer's market at that point. Now, here is the silver lining. So remember, our CMI is giving us this supply and demand indication, and so we track those two factors very closely in order to get the Cromford Market Index. Now, a lot of what has been affecting this is we're having the combination of, well, all that's been affecting this, the combination of buyer demand going down because we've had rising interest rates and buyers are not able to afford anything that they want to buy anymore because of the rates and the prices, frankly. And at the same time, we've seen a lot of sellers list their homes on the market because a lot of different reasons, but more than likely it's a FOMO seller, a panicked seller, fear of missing out. They're trying to get in before we hit the peak, and a lot of people have started to list their homes. So we have this increase in supply and this fall off of demand, and now we don't have as many people wanting to buy these homes that are on the market, so listings start to have to cut their prices, and so on. And so the silver lining, going back to what I was saying, is that the number of new listings on the market in the last 7 days actually went down as compared to the week prior. So the trend has been that every week we're getting more and more new listings on the market. And then the last 7 days, we had a number that was just slightly lower. So new listings are they were at 2,500 7 days ago for that week. And then this week it went down to 1,600. Oh, that was horrible handwriting, but you get it. 1,600 for the week. So we'll see if that continues because it has felt like it's just a stampede of sellers coming into the market, and we have all of these listings hitting the market at one time. And so there's got to be a backstop somewhere, right? There's got to be a stop where the people that want to sell have all listed, and now we're going to be a little bit more stable. And so maybe this is the beginning of that. I don't know. We'll see what happens. So here is your Cromford Market Index dials. Again, anywhere between 90 to 110 is balance. So we are still in a seller's market at 177.6. I know this date is slightly dated, but they don't always update it every single day, especially weekends and holidays. So this is the most up-to-date information that I have at the moment. Our demand index is sitting at 88.2. So we are officially below normal for our demand. We had been above normal for a very long time and now just got out of that normal range. And then our supply, as I was saying, continues to go up. Our supply is at 49.7. So we're still 50% below a normal amount of supply, still undersupplied. But as you lose demand and you increase supply, you are seeing the market soften altogether. A balanced market just means that this number and this number are equal. That's all we need to do. So it doesn't matter if those numbers are going to be 100 or if they're both going to be 80 or whatever. When supply equals demand, that's a balanced market. And at the moment, supply is rising, demand's lowering. We're probably going to meet, and then if they pass, we all know what happens there. We're in a buyer's market. So let's talk a little bit about demand. And so contracts that were accepted in the last 2 weeks, I have a lot of numbers here and I want to make sure I write them down appropriately. For the contracts that were accepted in the last 2 weeks, this is how they measure demand, which is going to be, contract activity, buyers and sellers meeting together and getting a house under contract. That is one of the ways that they measure demand. So contracts accepted 2 weeks ago was about 1558 for that week. And that is down from 1898 the previous week. So we've seen that drop off in demand between those 2 weeks. If we look back to 2021, the same week in 2021, the number of contracts that were accepted was 2274. So it's a pretty big difference between this and this. Obviously, the activity is much, much lower now than it was last year at this time. They said this is the least productive week that we've seen in 2 years in the Phoenix real estate market. And it's actually lower than April of 2020 in terms of productivity. Why is that significant? Do we all have to remember what happened in April of 2020? The pandemic started and everything froze and people were on lockdowns and no one knew what was going to happen with the real estate market or anything for that matter. And we just had lower contract activity this past week than we did when the pandemic started. So let that sink in for a moment because that's a pretty intense stat in my opinion. Now, talking about supply, more homes newly listed for sale, we've started to see this more than any time since 2011. And it's important to know, I know I just took you through the fact that in the last 7 days we had fewer listings, new listings hit the market. This information that I'm going through was reported right before we saw last week's listing numbers. So this does not apply to what I just spoke about. So that trend may continue. This is just looking back before last week, previously. So more homes newly listed for sale than any time since 2011. And that is 133% more than listings in 2021. And we're getting about 200 new listings per day, which is really hard to believe. So this is what's happening, with our supply and demand. We are seeing the demand go down with the number of contracts. We're seeing very low activity there. And then we're seeing 200 more listings per day come to market. So obviously there's an imbalance with those two in the opposite direction than what we've been seeing in the past. So if you saw my iPad, my disk is full, the battery's about to die, so I'm probably gonna have to sign off here quickly. That is luckily all I had to share with you guys today. So I appreciate you joining me on this holiday and thank you for all of your support. Remember, if you wanna know what your home value is, I've got a link down below for an instant home valuation. I also have a link to search my MLS if you're thinking about buying in this could be buyer's market, so it's a little bit exciting there. And also remember, I can help you with your real estate needs. If you're looking to sell a property or buy, I am able to help you with that. So reach out to me anytime by call, text, or email. All my info's in the description below. Thanks again for joining me. I hope you all have a wonderful holiday. I'm Caitlin McKegg with the Desert Dreamers team at HomeSmart.